Good afternoon, everyone. My name is Andrew Castleberry. Welcome back. Today we are wrapping up episode 3. So we're doing episode 3, part 4 on saving and investing. And what we're going to cover today is going to be asset allocation and diversification. So if you followed any of our other episodes with the saving and investing, we've kind of talked about different account types. We've talked about different investment vehicles in those account types. Now we're going to get a little bit more into how you construct a portfolio if you were looking to build it for a specific long-term kind of retirement planning goal or long-term just wealth building goal. So what we talk about with asset allocation and diversification are going to be crafting a portfolio with a specific goal in mind. Now, that's going to be different if you lean on the spectrum of needing it to be very, very conservative, like if it's a cash account or you want a cash equivalent in a portfolio. It's also going to be different from the style of portfolio you might have if you're doing individual stock holdings. It's going to be extremely risky or just extremely aggressive at that point. What we are really looking at when we're talking about asset allocation and diversification is going to be measuring the amount of return we want with the amount of risk we are willing to take. And that's going to be the relationship we talk about in crafting that portfolio. So first off, I want to talk about really what's the difference between asset allocation and diversification? Because a lot of times you hear them being kind of intermingled a little bit or used in the same way. So someone will use asset allocation and then a few minutes later they'll use the word diversification, which is pretty much like it's doable. They are slightly different, but they're also similar enough that you can interchange them depending on how you want to talk about it. But really, when we talk about asset allocation, I like to think of it as bird's eye view. Diversification is getting a little bit more granular, like into the portfolio. So with this example here, what we kind of see is asset allocation is your portfolio as a whole. So how much do you have in stocks? How much do you have in bonds? How much do you have in commodities? How much do you have in cash? Is looking at the different asset classes you have from a portfolio perspective. Then diversification is looking within one of those asset classes and saying, all right, what is the breakdown within the stock portion of your portfolio? Now, so what we see here is essentially stocks right here and the total portfolio value. And then that stock component broken down in and of itself over here would be how diversified that stock portfolio is. Now, at the same time, though, you could look at that stock allocation and say, all right, bird's eye view of that asset allocation is large cap, mid cap. And then you can get more and more granular as you go in. But tend to think of it as that idea of like asset allocation is a bigger picture. Diversification is kind of what that bigger picture is composed of, if you will. Like asset allocation might be pies, ingredients is going to be the diversification factor. But we'll start with asset allocation. So asset allocation, what you're really looking at is building something that's going to have things in it that all do slightly different things. So to use the same pie comparison, you'll have the crust, the filling, what the crust is made out of. So different components of that. All of it comes together to make one pie. So the fruit, the sugar, the flour, every single part of it comes to make a pie. You want that pie to all come together and work efficiently. You can't have a pie that's just flour without adding water, yeast, eggs, anything like that to actually turn it into dough. So when we come to a portfolio, for this as an example, you might have a portfolio that's 25% bonds, 20% growth, 20 or 35% growth in income, and then 20% kind of balanced at that point. So that might be something where like the bond portion is designed to do one thing, the growth portion is designed to do another thing, the growth and income portion is designed to do another thing, and the equity income portion is designed to do another thing as well. So you'll have all of those kind of building to be something separate. So a lot of times especially if you're Dave Ramsey fans, something similar to this, you'll hear like the 25, 25, 25, 25 portfolio, which will be growth and income, aggressive growth, and international. That'll be the baseline asset allocation, which means you have 25% of your account in international stocks, 25% in aggressive growth stocks, 25% in growth stocks, and 25% in growth and income. This is something similar, just a slightly different blend, but you're trying to build something designed towards an end goal. Someone that is going to be aggressively invested might have 100% stocks, and then the allocation becomes the differentiation between international, growth, and income, whereas someone that might be slightly more conservative, shooting for a more modest return, but a little bit lower risk, you might have bonds in that portfolio. So in this scenario, 25% bonds might be a portfolio that would make sense to you. Again, it is all going to be dictated by what your end goal is and what that design of the portfolio is trying to achieve. So then you go into that diversification aspect of it, and then you're looking at trying to take each one of those slices, so like the growth and income, the bond, the equity income, the balance side, and you want to own investments that are going to optimize each one of those categories. So you want to take it and you want to say, all right, well, if I have 4 categories in my portfolio, so let's say aggressive growth and income, international, and bonds, you don't want to hold one bond, then one international stock, then one growth stock, and then one growth and income stock. You're holding 4 companies for your entire portfolio. Yes, you have a asset allocation that makes kind of what you overall want to do, like it agrees with it. Like that asset allocation would be technically correct because you would have 4 companies for each one of your kind of 4 quadrants you want to invest in, and you could do 25% of your portfolio in each. But no one would really say that that portfolio is diversified because it's not. You still have a lot of your eggs in kind of one basket per se. So diversification is taking that asset allocation sleeve and it's breaking out the risk. So if you want to say, all right, well, I know 25% of my portfolio wants to be growth, and you're focusing on US growth. Well, what you might look at is say, all right, so if we come back to this one right here, you might have half of that growth be focused on large cap companies. So think Microsoft, Apple, Amazon. You might have some of those be mid-cap companies, so think like Domino's, Wingstop. You might have some be small-cap companies, so probably companies you've never heard of, but like a biotech company or something like that. So you're having different areas of the market all within that growth region that you would define as a company that isn't producing a dividend typically, isn't designed for income, and is still in the growth phase. So think of like a growth company is still actively trying to build, whereas a maybe income or growth and income company might be paying a dividend. So like Apple pays a dividend. It might not be, I mean, it's going to be a blend, but most people would maybe consider that growth and income now, or like a Johnson & Johnson or a Coca-Cola or Procter & Gamble. That's a little bit more of a developed company. Now you can still have those that produce really good growth, but the hairs might be split a little bit, which is why you tend to see those defined as like growth and then growth and income, because there's some overlap there. But that's the idea. You want to take that 25% of your portfolio that's going to be growth, and you want to say, all right, I want to build a basket of holdings that are all going to be geared towards growth, but I don't necessarily want that 25% to be tied to one individual thing. So you can shed some risk when you're diversifying out. That way, again, the old adage, all your eggs aren't in one basket. That is what you're looking to do. Now, with diversification and asset allocation, you're balancing the potential risk, though, with also the potential return. So what you're looking at here is essentially items on this side of the chart are going to be the least risky, and they're also going to have the lowest return. So cash, like cash in a bank account, it's not risky. It's not very risky, at least on a short term, but it's also going to have the lowest potential return. Like you're getting interest, so whatever the bank is paying you. So you're not taking a lot of risk, but you're also not expecting a lot of return. Then you look, the next bump up right here is going to be fixed income. So that's going to be essentially bonds at that point in time. So you're seeing a little increase in expected risk, and then in turn, you're getting paid a little bit more in returns. And then you're going to see essentially property, so like maybe real estate, shares, which is going to be typically stocks at that point, and then alternative investments, which could be a handful of things. That could be cryptocurrency, that could be collectibles, that could be anything you could think of. But what you kind of see is this isn't an exponential like straight line. It does kind of curve at that point. So every step up in risk doesn't necessarily equal the same potential in return. In a lot of cases, you'll have maybe one-offs that don't fit or outliers that you see, like an NVIDIA, for example, recently that has a huge amount of return, taking a huge amount of risk. But you'll see most of them kind of fit somewhere along here. So what you want to do when you're talking about building an efficient portfolio, when you're trying to say, all right, this is the money I want for my retirement. I want to build this portfolio around the goal of getting to a certain amount or being able to retire at 65 or being able to retire at 67 or 60 or 55, whatever that might be. You are crafting a portfolio with that goal in mind. You're not going for blind returns. This isn't what that is. That is a different type of investing. If you're just saying, I want to get the most return every single year as possible, you're not talking about diversification or asset allocation. You're not talking about crafting a portfolio for a goal. You're just talking about growth investing, no holds barred, which is extremely risky. Some might even argue gambling to an extent. Probably not, but it's one of those things where it's just a different type of investing. That's not what we're talking about. We're talking about crafting a portfolio that says, all right, for the amount of risk I'm willing to take with this, what's the maximum return I can get? And what you want to do is craft a portfolio that's somewhere on this line. So you want to say, all right, I might want this amount of risk right here, over here. So how do I build that to get this amount of return? Is it 80% stocks, 20% bonds? Is it 90% stocks, 10% bonds? Then out of those stocks, is it growth stocks? Is it conservative stocks? Is it income stocks? Is it international stocks? Is it for fixed income? There's different types of fixed income. Is it government bonds? Is it corporate bonds? Is it corporate high yield bonds? All of those are going to be peppered all along this line right here. So what you want to try and do is get something that is close to sitting on this line as possible. Because if you have something down here that's sitting up right here, and you're like, all right, well, my portfolio, if I map it out right here, is sitting right here. Well, what you're really saying is, I'm willing to take a ton of risk, but my expected return is garbage. That's what you don't want. And in turn, if you're way up here, you might have a really, really high potential return for a really, really kind of moderate potential risk. But the likelihood of that portfolio even existing is almost non-existent, or the likelihood of that being a one-off fluke is really, really high. So what you tend to see is portfolios clustering around a chart kind of like this. This is technically called an efficient frontier, if you will. Like that's going to be the pace of like where you typically see the best returns on a diversified portfolio. And that's what you're gunning for. You want to say, how do I craft a portfolio that gets me to here so I can kind of balance my return for the amount of risk that I want? It's something, if you're not comfortable with this, talk with an advisor, meet with us. This is what we do for our clients. We build models and portfolios for this, but it is one of those things that, again, you can build it in theory by kind of doing the broad asset allocation, but then you actually have to look and say, all right, well, what do I actually invest in? How do I rebalance that? How do I actually construct that? What do I need to do in each account type I have? So like, not only are we looking at this as a whole, but are you doing the same portfolio in your IRA, your 401k, your Roth IRA, and your brokerage? Probably not. You're doing a little bit different one of those. So your entire asset allocation between your entire financial life work together. You might do something slightly more aggressive in your Roth IRA, and you might do something slightly more aggressive in your 401k that you're adding to more consistently. You might have a more conservative allocation in your brokerage that you might be using prior to retirement, and you might have a more conservative allocation in your IRA that you're no longer adding to. So you use the risk portion in two of your accounts and the more conservative portion in two of your accounts to where your total risk might be, say, a 6 out of 10, with 2 of your accounts being an 8 and 2 of your accounts being a 7 or a 4 at that point. So kind of breaking it down that way. Now, the big question is, well, why do I even want to do this? So we've talked about asset allocation, we've talked about diversification, but why does it matter? Like, what's the point? Shouldn't I just want the best return overall? And I mean, that's reasonable. And you do want a good return. But when it comes to retirement planning and when it comes to building, oftentimes you're looking for what gets you the highest likelihood of success. And that isn't always the best return, because when you go for something that's going to be extremely high risk, what you're seeing isn't just all the good years, you're also seeing some of the bad years. And then it becomes kind of a little bit of behavioral mechanics as well. So we can assume you're going to buy and sell at some point in time. So we have to kind of bake that into the plan as well. But what you kind of see here is, if you are really aggressive and you lose 70% of your portfolio, so you get a 70% sell-off, which you see in individual stocks on a yearly basis, not uncommonly. I mean, that's not a lot, but like 2022, you saw a lot of individual companies that had a 70% sell-off. You need a 233% return to get back to break even. So it's not you lose 70, you have to earn 70 back. It's you lose 70 and you need a 3.3 times gain to get back, or a 233% gain to get back. If you lose 10%, you need an 11% return to break even, 20%, 25% return. So it exponentially grows. So by looking at it and saying, all right, well, I want to hedge my risk in a really volatile few years or a really choppy market, a more balanced portfolio can actually out-return an aggressive portfolio, just because you're not actively having those massive downswings and then needing those upswings. And this is assuming you're staying invested too. Like, a lot of times when I talk about that behavioral mechanic, if you see a 60% sell-off in your account, more than likely you're probably going to trade. It's just human nature to try and mitigate that lack or that loss as much as possible. And investing isn't something where you can just trade harder and get a better return. That's not how it works. In most cases, the more you trade, the worse off your actual return is. So what you see with a lot of kind of just individual, really aggressive investors is, it's not only about finding the right investments, which is already an extremely daunting task that the best minds among us have a hard time doing. It's also something where you have to have an extreme discipline to not sell at the wrong time and let that recovery come. Now, when we look at an example of someone that's kind of building out a diversified portfolio, that's the goal of what you want. What you kind of see here is 3 kind of scenarios here. And we're going through a period where you were investing in several different types of portfolios through 2000 to 2018. So a fairly choppy 10 years followed by a fairly decent 8 years period. So when we talk about diversified portfolios, one of the benefits is it reduces the risk, but it also can help enhance the long-term returns, especially if you're starting to take distributions in the next 20 years or you're making contributions. It just kind of allows you to have a little bit steadier ride that can limit some of those really severe drawdowns and then help you kind of have a little bit better peace of mind about your account and then have a little better end result. So if you're too conservative, and in the scenario that someone that's just retiring, they're retiring and they're looking at spending down their assets. So in this case, they're retiring with $100,000. They're withdrawing $4,000 a year and adjusting that for a 3% annual inflation rate. So if you're very conservative and you go through the 2000s, well, you don't see a huge dip in the dot-com bubble. You don't see a huge dip in the financial crisis in 2008. But by the time you get to 18 years out, you also have the lowest dollar amount. So you're technically on the most conservative spectrum of this, but you didn't have any real return. So you just slowly spent down your assets. So what happens is that's the worst case scenario for you. So someone that is risk adverse and holding cash, whether they're in retirement or whether they're not in retirement, that might seem wise in the first few years. But over time, inflation is going to erode your ability for that money to do anything. And you are slowly going to see that be less valuable and less valuable and less valuable at that point in time. Next, what we're going to look at is essentially see that if you are too aggressive, those big market swings are going to cause you to really adversely feel more of the down markets. And then that's not going to allow enough of your account to be left over to experience the up markets at that point. Now, this is specific to a retiree. So someone that's 100% risk on at that point, you go through a really bad drawdown, you're actively taking income. Taking that income on top of a portfolio drawdown exacerbates it. So what you end up seeing is a more negative result, not quite as bad as the cash person, but still really bad. And then you have a kind of more balanced portfolio that still sees ups and downs, but is able to weather an environment like that. Now, all things aside, you have to look at it. If this was going from 2008 to 2024, what you would see is the aggressive portfolio would outpace, because over that period of time, so that 10, 11, 12, 13, 14, 15, 16 year period of time, what you would see is that aggressive portfolio would be growing, and you'd only have a handful of years that really were major down years. You would have 2018 and 2022 at that point. You'd have some rockiness in 15 and 16, but not a ton. And the aggressive portfolio would outperform. But then if you get into a period, which is very likely to happen because we've seen this historically, you had a 70s decade that was pretty rough. You had a 2000s decade that was pretty rough. And then you had decades in between that were really good periods of time for the market. It's something that kind of is ever changing. So you can tweak that portfolio every so often at that point and have that be something that's not necessarily entirely stagnant, and you can adjust that allocation over time. So this is not something you set up and you set in stone. This is not something that you necessarily are going to never change, but it'll be something that typically you are going to look at and you are going to review. All right, for where I sit today, for what my goals are today, for what I would like to do now, what I would like to do in retirement, what I would like to do in 5 years, what I would like to do in 10 years, what does my allocation need to be? What should I be doing? What is going to be the most advantageous thing for me to do to where I can see a lot of benefit from my accounts and I can ultimately see the best potential outcome? Because again, the key point between diversification and asset allocation is you are building a portfolio for a specific goal. So what you are trying to do is you want to determine what that goal is first. You want to lay out how much risk you need to achieve that goal. So not necessarily even how much risk you're willing to take first. You want to say, how much risk do I need? So what return do I need to be shooting for to achieve that goal? And then how much risk is that return going to require at that point? So figure that out. Then you want to look and say, all right, well, what is my investment strategy? What is that kind of timeline for that goal? Then you look at kind of building out, what are my asset classes I want to invest in? What are the different holdings I want to do in that? And then how do I manage that on an ongoing basis? So when we look at it, you, again, start from the goal. What does that goal require you to do? Then what do you have available to you? 401k account type. How is that asset allocation going to be built? How are you going to diversify that to kind of protect yourself? And then how do you maintain that? And how does it need to change every single year? And it might not change year to year, but it will slowly change over time. But guys, I hope this was helpful. Again, this is the last episode on saving and investing. We're going to move into our next segment, which is going to be kind of debt management at that point, which is super fun. But I appreciate it. If you like this, subscribe to the channel. Again, hope it was helpful. And please feel free to reach out if you are to the point where you don't want to do this on your own. What we've done is, for many, many clients, is help partner alongside of them, either one-off or kind of help partnering hand do it with them. But it is something that if you're not actively thinking about this and you are trying to plan for retirement, or you are trying to plan for a goal 10, 15 years from now, and you're just investing kind of blindly without thinking through what you really need, and you're just trying to pick the hot stock of the day, it is something I would really, really strongly recommend you look at taking a little bit more serious look at your investment strategy and saying, do I need to start implementing a more systematic strategy to achieve my goals, and then how do I go about doing that? But again, thank you, and hope you have a great afternoon.